Hello, this is Gary Sherman of Whaddadunce.com. In part one of our series on bank valuation, we will talk about the bank business model. And when we talk about the model, we will use Bank of America as our proxy company. In this slide, we present the financial statements of Bank of America for the 12 months ended December 31st, 2025. And the financial statements are, you can see that to the very left-hand side is the balance sheet. The balance sheet is a snapshot of where they were at December 31st, 2025. Now, the income statement is that block that's next to it. This is the income and expense that was generated over the 12 months ended December 31st, 2025. And then the block after that are some ratios and things that we're interested in. So if we look at the blue arrow, this is what the bank primarily invests in that they make a spread off of. We have cash. We have marketable securities, which are debt securities, could be treasuries, corporate bonds, investments at the FHLB, all of that kind of stuff. And then we have loans receivable. This is the amount of money that's invested in, car loans, consumer loans, mortgages, that kind of stuff. So that's what the bank earns a spread off of, those three items. Then if we look at the yellow area or the yellow arrow, that's common stock. This is what we want to value. That 287 number, that's cost. And what we want to do is we want to get the market value of common stock because that's going to be indicative of the share price. And then if we go to the green arrow, that's net income after taxes. That's taking all my revenues and all my expenses. And then I take out my taxes, and that's what I'm left over with, about 3,509. Then if we go to the gray area, these are the amount of shares that are outstanding. The outstanding shares are the actual outstanding shares at the end of December. The fully diluted shares, that assumes that all of the options that are in the money are exercised. And whenever we calculate earnings per share, we use fully diluted shares. And if you look at the black arrow, that's the financial ratios. And notice that those ratios are on a GAAP basis. GAAP means generally accepted accounting principles. It's the rule book that all companies have to follow when presenting financial data. And those financial ratios are based on GAAP. But when we calculate financial ratios, we're going to make some changes to it. It'll be close, but not exact. So at the end of the day, what we want to do is we want to value that orange arrow, the common stock. That'll be the value of all the common stock. And then what we want to do is divide it by the shares. And so in this case, we're going to take the maximum of outstanding shares or fully diluted shares. In this case, it's fully diluted shares. So if we take the value of common stock, all common stock, divided by the number of shares, we'll get a share value. In this slide, we want to take a look at the balance sheet of Bank of America and make a couple calculations. That first block there is base assets. Notice we start with the total GAAP assets. So if we went to the previous slide, the financial statement, the total assets, that would be GAAP on a GAAP basis. What we want to do is we want to add the loan loss reserve because actually that's an allocation of capital. So we reclass that to capital. And we subtract out goodwill because goodwill is iffy value. If I buy a company, say for $1 million, and its assets on its books are $900,000, that means I overpaid for that company just based on the value of assets by 100,000. Well, that's goodwill. So that's we want to take that out. So if we start with total GAAP assets of 3370, make those adjustments. Our total base assets is 3315. We want to do the same thing with capital. We start with total capital, GAAP capital, which is the 303 number. We add in the loss reserve, the loan loss reserve, because that's a capital bucket that we net against our loans receivable. But in this case, what we want to do is we want to count that as capital because that's what it is. And then we add back the unrealized losses. These are the losses on whenever interest rates rise, like they have recently. A bank has an investment in some fixed rate securities. And as interest rates rise, the value of those securities goes down. But rather than running it through the income statement, they're running it through the capital account. So we want to add that back. And then we want to subtract out goodwill. So if we go to the top right-hand side, the capital to assets ratio, this is, remember when I said that banks are all about leverage? This is what I mean by leverage. We have base capital of 257, but we have base assets of 3315. So the capital ratio is only 7.78%. So if we look at that balance sheet financing graph, you'll see how the bank is financed. And it has, let's say 100% represents the assets. If you have 7.78% in capital, that means the difference is debt financing. So you can take a look at that and say, well, geez, it's not going to take many losses in base assets to completely wipe out my capital. And that's what the regulators are looking at. What they want to do is, let's say that the Fed takes over the bank and they sell their assets. What they want to do is they want to sell the assets and have enough money available to pay their debt. And with only 7.78% of that in capital, that capital base is going to be wiped out pretty quickly. So how can banks operate with that kind of leverage? Because you don't see that for Intel, you don't see that for any of the mining shares, none of that. The reason why they can is because they're hedged. And you have to realize that on the asset side, if interest rates go up, a lot of my asset values go down. Now, the same can be said on the debt side. As interest rates go up, now I have below market rate financing, so the value of my liabilities goes down. So I'm hedged. If I have let's say my interest rates go up by 1%, I'm going to lose money on my assets, but I'm going to make money on my debt financing. The same thing if interest rates go down. My assets are now worth more, but then again on the debt side, I'm funding myself at over market rates. So in a sense, the bank is hedged, and therefore they can run with such a low capital ratio. Now, the statement below, a bank is a traditional long-short hedge fund in disguise. Well, that's what a hedge fund is. What does a hedge fund do? It basically goes long-short correlated assets. So if I have a hedge fund, let's say a tech hedge fund, and I want to make money on investing in, let's say, Intel, and I want to make money investing in, say, AMD. Intel and AMD are in the same business. So in a sense, they're correlated. So what I want to do is if I think that Intel is going to perform better than AMD, I want to go long Intel shares and I want to short the AMD shares. Therefore, I'm hedged. And that's what a hedge fund does, traditional long short hedge fund. And that's what a bank is. If you look at the bank balance sheet financing graph, that's exactly what's going on here. They have base assets that are sensitive to interest rates, and also the debt is sensitive in interest rates. So really for the bank, I'm going long the base assets and I'm going short the debt financing. Time series data is very important when you're talking about valuation. Let's take a look at this chart there. The FRED stands for the Federal Reserve. Now that's a chart of the capital to assets ratio over time for all banks that the Fed looks at. So you can see that around 1999, the capital ratios were around 8%. And then right around 2008, when we had the financial crisis, all of a sudden the capital ratios picked up. Well, this is what the Federal Reserve wants. They basically took a look at the banks and wanted them to be better capitalized. So they encouraged banks through just regular encouragement or via regulations, told the banks that they had to carry more capital. And so that's what we see here. We see that based on all of the banks in the Federal Reserve's population, the capital to assets ratio went from around 8% all the way up to around 11 or 12% at the end of 2020. Now, this series has been discontinued, which is unfortunate, but let's take a look at this anyways. If we look at the graph or the table to the right, the summary, this graph goes from 1998 to 2020, and the mean and median averages, the average capital ratio over that time period The average was 10.68%. The median was 11.02%. And then we take a look at Bank of America's capital ratio at only 7.78%. And you might ask the question, why, if the Federal Reserve wants banks to be better capitalized and the average, or at least towards the end of 2020, the average capital ratio was around 11 or 12%. How can Bank of America operate on 7.78%? Well, probably is because of, and we'll look at the asset composition of Bank of America, but Bank of America has a lot of their deposits invested in securities. So if I have a lot of money invested in securities that are AAA rated, like or corporate highly rated, investment grade securities, the Federal Reserve basically says is I don't have to carry a lot of capital to support that asset base. The same thing with cash. If you have, in this case, Bank of America has 237 in cash. So the Federal Reserve basically say, or the bank regulators basically say that, you know what, you don't have to hold any capital against those that cash balance. Where you really need to hold capital is on your loan portfolio. Your loan portfolio is going to be credit cards, auto loans, consumer loans, and that kind of stuff. You're going to have a lot of capital allocated to that capital or that asset bucket. But in Bank of America's case, you'll find out that its loans receivable or its loan portfolio is only about 35% of its total assets. So therefore, it doesn't need to carry as much capital as, say, a bank that was heavily invested in credit cards, et cetera. This slide takes a look at Bank of America's asset composition. So if you go to its balance sheet and ask the question, how does Bank of America, where is this money going? And we can see that based on the table to the left, we have 239 in cash. That's about 7% of assets. We have investment securities of 1609. That's about 49% of their total assets. And this is where Bank of America has most of its money invested in a relatively low rate, investment grade securities, treasuries, whatever. And this will have an impact on their margins, which is interest income minus interest expense, which we'll take a look at later. Their loan portfolio is about 36%. So their interest earning assets, or assets that actually earn revenue, is about 92% of total assets. The difference is the non-interest earning assets. This would be any of the branches I own, computer systems I own, what have you. If I add all that up, that's 275, and that's about 8% of total assets. From the bank's perspective, what you want to make sure that your non-interest earning assets are as low as possible, because you want to have the highest percent of your assets actually earning revenue. And if we take a look at the pie chart to the right, we can see those percentages broken down. And as you can see, the biggest piece of the pie is the investment portfolio, which is about 48%. And then the next biggest piece is the loan portfolio, which is about 36%. So that's just a graphical representation of the table to the left. In this graph, we take a look at where Bank of America gets its revenue. Where does that revenue come from? Now, remember that a bank is primarily in the spread business. So they pay a certain rate on deposits, and then they lend out those deposits at a greater rate. So therefore, their net income is going to be based on the spread between my deposit rate and my lending rate. Now, the first table there is I take a look at my interest income and interest expense. This is the spread side of the business. So my net interest margin is the difference between those two. And you can see that's about 60,096. And then I divide that by my interest earning assets from the previous page. And so my net interest margin is 1.98%, which is relatively low, but you have to remember that Bank of America invests most of its dollars into securities versus their loan portfolio, which is higher yielding. So their net interest margin as a percent is about 1.98%. And remember that also that we said that about half of the bank's income, or banks in general, half of their incomes comes from revenues outside of the spread business, basically fee income. So if we go to the very bottom of that says non-interest income, we have fees and commissions, wealth management fees, deposit fees, investment banking fees, card fees. Then we have market making and trading, and then we have other income. So that's all non-interest income. And if we take a look at that second table, we can see that Bank of America's non-interest income was 53,001. And if we divide that by earning assets again, that gives us a ratio of about 1.74%. So if we take a look at the pie chart to the right, about half of their revenues comes from the spread business, and the other half of their revenue comes from the fee business. In this slide, we want to take a look at non-interest income for banks in general. That graph to the left-hand side, that's non-interest income for all the banks that the Federal Reserve looks at. We can see that the ratio of non-interest income to total income. So in other words, if I take non-interest income and divide that by non-interest income plus the income from the spread business, I get around 40%. And that's pretty constant. So if I take a look at that summary table to the right, the table goes from 2000 to 2021, and again, this chart was discontinued, which is unfortunate. So my averages are my average ratio is around 39%, and that's also the median too. And if we take a look at Bank of America's ratio is around 46.9%, which is more than the average for all banks. And this is primarily because the spread business of Bank of America relies heavily on debt securities, which are relatively low rate versus its loan portfolio. So therefore, the spread business is less, is less a piece of the pie than the average bank. So therefore, its ratio of non-interest income to total income is greater. In this slide, we're going to take a look at net interest margin, which is defined as my interest income. That's the interest I earn on my cash, securities, and loan portfolio, minus my interest expense, and that's the interest that I pay on my debt, which is primarily deposits. So the graph on the left-hand side is my net interest margin. And you can see that so this goes from 1994 till 2020. So my interest margin has declined from around 4% at the beginning of that time period to around 3% by the end of that time period. And if we take a look at the table to the right, the summary table, we can see that graph goes from 1984 to 2020. My mean is around 375 and my median is about 385. And then we take a look at Bank of America's net interest margin, which is 1.98%, which we derived in a previous page. So you say, well, geez, I mean, Bank of America is only making 1.98% on their assets or on their interest earning assets versus a mean and median for all banks of around close to 4%. And if we take a look at the graph to the left, we can see that the net interest margin has trended down to about 3%. So we can use 3% as what pretty much what we're looking at for all banks. So we say, well, geez, all banks are making a 3% margin, but Bank of America is only making around 2%. Why the difference? And again, we go back to the how Bank of America invests its funds. Most of its funds are invested in relatively lower rate debt securities versus the loan portfolio, and that's why its net interest margin is less. The next thing we want to look at is Bank of America's expenses. So the first thing we want to do is take that look at that first table, which is the efficiency ratio. Now, this is a real hot topic in banking. Basically, what we do is we take my non-interest expense, which is employee compensation, bonuses, employee benefits, leases on my branches, all that kind of stuff. And I divide that by net interest income, which we define here as the income from the spread business plus my interest or my income from the fee business. I add those two up, and we'll define that as net interest income. If I divide those two, my efficiency ratio is 61.65%, which is in line with what a lot of the big banks or most of the big banks actually pay. The next item is my net charge-off rate. Let's say I loan a $10,000 on a car to John Doe, and John Doe ends up defaulting on that loan. And I basically when he defaults, I take back the collateral, which is the car. I drive that car to auction, sell it, and let's say I get 8,000 for it. So therefore, my loss on John Doe's business is $2,000. Um, net charge-offs, we should be able to, or we do, by looking at the financial statement notes, we can get an idea of what net charge-offs were, actual net charge-offs were. But that's going to be a problem as far as creating my financials, because that's not easy to get to. So what I'm going to do is use the loan loss provision as a proxy for my net charge-off rate. So if I take my loan loss provision of 5675 and I divide that by my loan portfolio of 1190, then I get a net charge-off rate of around 48 basis points. And then the next item there is my income tax rate, which is easy to calculate. I take my income tax expense of 7186, and I divide that by my income before taxes of 37,695, which I can find both of those values on the financial statements in the previous slide. And the ratio there is about 19%. And that makes sense because my federal tax rate in the US is 21%, but I still have to pay state taxes, but I also have some tax credits. So 19% makes sense. And then if I take a look at that pie chart, this is how the expenses, how those buckets relate. You can see that 84% of my expenses is all non-interest expense, primarily employees. And then I have those other buckets for net charge-offs and income taxes. In this graph or in this slide, we want to take a look at Bank of America's efficiency ratio. And the chart on the left-hand side, that's the efficiency ratio for all banks over a given reporting period published by the Federal Reserve. And we can see that the efficiency ratio is pretty constant from one year to the next, and it runs around 60%. And if you look at the table to the right, we see that that graph goes from 2000 to 2021. My average or my mean and my median efficiency ratio is around 59%, plus or minus. Now the efficiency ratio for Bank of America is 61.65, which is slightly higher, but not much higher. And really what we want to do here is we want to see if the bank has any room for cutting expenses. So in other words, we can model out that if we use the mean reverting model, valuation model, then we can basically say that my efficiency ratio is going to start out at 61.65, but it's going to trend down to something lower. But in the case of America versus all the other banks in the population, I mean, their efficiency ratio is in line with the other banks, so there's really not a lot of wiggle room there. In this slide, we want to take a look at Bank of America's net charge-off rates. So if you take a look at the graph to the left, this graph goes from 1985 to 2026. And you can see that right around 2008, 2009, there was a big spike in net charge-offs, which makes sense because that was the great financial crisis. So, and if you take a look at the table to the right, we can see that the graph again goes from 85 to 2026. The mean or the average charge-off rate was 85 basis points. The median was 65. And the charge-off rate for Bank of America is about 48 basis points. If you look at that graph, you'll see that 48 basis points corresponds pretty much to the 2026 average of around, a little bit above 50 basis points. And that 48 basis point net charge-off rate, that's a good time rate. So if we use that 48 basis points as a go forward rate when we do our modeling, that's not going to encompass the bad times. We want our charge-off rate to encompass both the good times and the bad times. And if we use 48 basis points for our charge-off rate for Bank of America go forward, we may be understating charge-offs and overstating value. So come join our community at Whaddadunce.com. It should be fun.